tsunami. And I'm reading from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves. Good evening, everyone, from Chicago. It's Thursday, June 4th, and this is CB3 CMT Live. I'm your host, Charles Brown, Portfolio Manager with CB3 Financial Group, and this is episode 13. Wow, we've made it 1/4 of a year. We are so pleased you've decided to join us tonight, and we hope it's going to be a fun show for you. We're going to wait for a few people to show up, but while we're doing that, the rest of us that are here will remind ourselves of the mantra, adversity is inevitable, but misery is a choice. And we have definitely had adversity this week around the nation. Adversity is inevitable, and it happened this week. But misery is a choice. That's really important to remember, really important. Tonight's theme, the new economy. The new economy. Hi, Larry and Connie. Glad to see you guys here. We're going to wait for a few more people, and just a few comics here. I've been throwing these out as the COVID episode started in March, and we began these broadcasts sitting on my couch, and my husband sweetly whispered, "The best part about all this is that I get to spend more time with you." And as I looked over at him lovingly, I realized he was talking to the dog and not me. That had to be an insult. Okay. You've been told that you can't see COVID-19. Well, I found it. I'm not sure if this photo came from one of the last few days here in Chicago at the protest, but if COVID-19 was a person, this is probably what it would look like. All right, really cool feature here we'll tell you about before we begin the program. We now have the ability to index our videos. So if you want to go back and see an episode, maybe not the entire episode, but just a segment or two from it, the next day when we edit the video, usually about noon tomorrow or so, you will be able to go to just a specific part of the episode if you'd like. So we hope you enjoy that, okay? All right. 3 topics tonight, a little bit, I guess, less topics than we normally have, but CoronAmerica. Now, it's different because we're winding down Corona in America, but the after effects are still here. So we'll put the economic items that affect or are affected by CoronAmerica in this section, and then we'll talk about the U.S. economy. And now we have a brand new section for you tonight, okay? Brand new segment, bull case, bear case, okay? The former CB3 investments and what we're looking at is now encompassed in one place, and we hope you guys are going to be entertained by this. So this is probably the last time I'm going to show this chart, but it's realistic that we need to understand we've crossed 107,000 deaths in America from COVID-19, 6.5 million around the world, 19,000, just since yesterday. 1,000 almost, 994 new deaths in America. Still, the numbers are on the descent, and that's what we want to see. So as I said, this section is going to transition from purely talking about the data of COVID-19 to the transitional data and getting America back on track starting next week. I've told you in the past that we like to see numbers where the charts are going up, and sometimes we want to see them when they're going down. And this is one where we want to see them going down. These are weekly unemployment claims. We got under 2 million. Now, again, look at the blue dash there in 2019. at the bottom, you can see that it's crazy, just this jump that happened in March this year. But the positive thing is the direction is going down, and the red bar is there because we got below 2 million new claims. Still a whole lot of claims, but going down. Now, every first week of the month, ADP, Automated Data Processing, the largest payroll processor in America, publishes unemployment statistics. And then Friday, tomorrow, the monthly May unemployment numbers will come out, and then I have to talk to you about those next Thursday. Now, you see a change here of minus 2.76 million, and that sounds horrific. It is horrific. Small businesses, 435,000 of that, mid-size 722, large 1.6. But here's the impressive part. The expected number was minus 9 million. So you see the spike up there, minus 9 million, and it was only minus 2.7. Again, everything's in relative terms here in 2020. It's a better number than the market expected. And certainly this unemployment is not unilateral across the U.S. I put this chart here to show, interesting, that the city of Minneapolis is one of the cities listed on this chart. Washington, Detroit, Los Angeles, Las Vegas at the top. Almost 35% unemployment, and that's what happens in America or anywhere where you have a one industry economy. And that's the risk that they took. It's the risk Detroit took to some extent. You could say it's the risk Orlando takes, although they have more than just Disneyland, but that's what's going on with this chart. Now, you hear people say, well, the government's run out of money. They had this $2 to $3 trillion package, but now they've run out of money. That's actually not true. And this is straight from the Consumers for Responsible Disbursements, as well as federal agencies reporting that only $500 billion, which is a lot, of money for the Paycheck Protection Plan, that's a lot to say fast, has been claimed. There's still another $250 billion that's available for businesses to use. So the blue bar on here, the blue portion of the bar, represents money that's been claimed. The gray, that's money that is still available. So money has been allocated, and for whatever reason, either red tape or just business owners that thought that they might need the funds have turned out to not need the funds, and that's why you see these gray pieces on there. So the question was asked in this survey from LendingTree. So LendingTree is a huge mortgage lender. Once you're able to reopen, will you bring back the same staff level as before COVID-19? A little bit less than half said yes, it'll be the same number of employees and the same number of hours. So that's not a great sign. Less employees, less hours, 23%. No, the same number of employees, but less hours. And then less employees and less hours, only 9%. So this is a snapshot taken right now. This could change, and it all has to do with GDP that the consumer is able to generate once this pandemic ends. And GDP is a topic later on tonight we're going to spend a good amount of time on. This is one of those charts that's turned up, and we like that because even though it's negative, new car sales, the second week of April, were down almost 60% compared to a year earlier. But here we are in May, and now they're only down 28%. That is an enormous move forward, and it shows that, to me, that there's still appetite out there, that the consumer has not been scared away. And that's the kind of data that we'll need to get our GDP back on track. So the ISM is the Institute of Service Management's non-manufacturing index, rebounded from in May, 45.4. The consensus was only 44, and April was 41. So we want these numbers to be above 50 if you look at the last paragraph. Above 50 shows growth, but would you think that we're already at 44? I mean, we're still reporting an increased number of deaths even though the trajectory has been reduced. But this to me shows resiliency, it shows optimism, and it shows determination in the employers of America. I just think this is a very positive thing. Two more data points. April personal spending down, of course, 13.6, but the expectation was down 15%. So Americans spending a little bit more than they were expected to for the month of April. Sometimes this data lags by 5 or 6 weeks. Here's the astonishing one to me. April personal income up 10.5% versus a loss of 6.5%. Now, I haven't been able to attribute this data yet. I believe it because I think briefing.com is a great source and a trustworthy source I've used for years. I'm thinking it has to be wage increases from essential medical personnel that were offered huge premiums to go to highly contagious zones. That has to be the reason, but that is an encouraging graph. What are people doing with these increased amounts of revenue? Well, it's pretty obvious if you look at the blue section of the chart. They're saving it. They're saving it probably because they don't know what the future holds. Most of the time, Americans save out of fear, not out of wisdom. And I hope that doesn't sound either patronizing or condescending. I don't mean for it to, but that's just the data. People tend to save more when they become scared. So here's why this number is so important. The key takeaway is that the personal savings rate, which you saw has just increased, has skyrocketed 33% from a year ago at this time. Now that's a lot of pent-up spending potential. Just because they're saving now doesn't mean they're going to keep it. They could be saving for, maybe we are going to get that house. Maybe we are going to get that car since prices are dropping like flies. What is done with those savings will be the key to the trajectory of this recovery in the U.S. And that's one of the reasons why I remain so optimistic, because that potential is there with those savings. Now I need to address something. I've had 2 clients since I've seen you last, and even though we've had these horrible riots, which we'll get to in a little bit, that have said to me, I got to tell you, I'm reading more, I'm spending time with my wife, I just kind of feel better about things, and I haven't minded being so cooped up. And there's this guilt issue about doing pretty well in the lockdown. The reality is that some industries are just not going to come back. I think lifting the lockdown is going to revive many businesses, and you're seeing this. I showed you the data last week with Disney opening up. We saw the car sales data just 3 slides ago. But here's 3 industries that concern me: cinemas, colleges, traditional colleges, and some, but not all, restaurants. So it's a long article of the Wall Street Journal about people that are installing home theaters, literally people that had never had a home theater, installing one in their current home, or get this, buying a 2-flat and putting the theater in one area of it and, setting it up for probably not rentals, but for parties and gatherings for small groups, on the anticipation that the additional amount of live streaming content is going to be available. We're already seeing in the news, and I know this isn't on the slide, that Apple is now planning to stream concerts, live popular music concerts, this autumn. And that is a pretty scary thing if you're AMC Theaters. Now, one industry that I think is also going to be affected to the downside is higher education. So the trends were already there. State funding had been dwindling, a decline in foreign students, and a broad decrease in demand. Basically, it's possible that students that have been learning online might say, I don't know that I want to be on campus, have a risk of infection, go to crowded, huge, freshman and sophomore classes. A lot of times you have lectures with hundreds and hundreds of kids in there. It remains to be seen what enrollment's going to be like this autumn. We know from 2 episodes ago, I told you that Notre Dame is reopened, Indiana's reopened, and I'm sure others will follow too. The third of the 3 concerned areas that I have are restaurants. And I've shown you a variation of this graph in previous episodes, but you can see after basically flatlining Some states here, most in the South, although New York is included and it's not going anywhere, as you can see, but the southern states, we are starting to see a pickup. This is data from Open Table, which is a huge reservation company. I made the joke last time. If you don't remember, a reservation is what you used to call ahead to get in a restaurant. So I think that's a positive. I think that seeing that upturn is a positive, but it's not across the board, as I said just 3 slides ago. So which would you expect would be most egregiously affected by this downturn? Fast food, fast casual, which is going to be like Chipotle, casual dining, which is, on the border or something, and then fine dining, 4 stars and above. Well, guess what? People are saying, no, I'm not going to go risk, getting ill and pay $200 for a meal. We're just not seeing that recovery in the fine dining at all. And all this we'll have a lot more data, of course, by the end of the year, but that's what we're seeing right now. Churches, too, obviously will be affected. One of my clients actually is one of his gigs is he's a choir director or music director at a church where they're going back to live services this weekend. He told me they're having 4 masses on Sunday, but only allowing 300 people in a 1,000 person capacity church. Or it'll be interesting to see how that works out. But people that have gotten used to worshiping at home, how's that going to play out? We don't know. We don't know. And financially, is giving going to go down? Now, at some point here in the next few weeks, we're going to have the senior pastor from Moody Church, Pastor Bill Burchie, online talking to us about that. Vacations reopenings, okay? And this depends on what part of the country you're in. Georgia was the first state to reopen, and they've had hardly any acceleration at all in COVID cases. And yet Texas, in that first week to 8 days of opening, now has seen an acceleration in cases, and they can't really figure it out. We're in the summer months. It should be more favorable for the virus situation, but it's actually worked against them. So hundreds and hundreds of people on the beach, great for the vacationers, maybe not so much for the people living there. Again, these are trends we're watching. So I had this slide last week about Silicon Valley saying we're working for home, and we're seeing just an amazing amount of companies that are not only embracing working for home, but wondering why their employees are going to want to live in a big city. I mean, if you live in San Francisco, why would you live in San Francisco if you can work from home? You might as well be in Salt Lake City and have beautiful mountains, right? I mentioned last week that Mark Zuckerberg said 90% of our staff will be working at home in less than a decade. And I think that is going to be a pretty seismic change, which is why I highlighted the last line here. Office REITs need to prepare for possible Armageddon. Hundreds and hundreds of thousands of square feet available in Chicago, even if the leases are paid out. Will they be renewed? I don't know, but I can tell you one thing. We are not investing in REITs right now, for sure, at CB3. Now, obviously, we have a social, emotional, and moral conflict happening in America. It's not my job to comment on that politically. It is my job to comment on that financially. Major cities across the U.S. reeling from this months-long lockdown, now are having to deal with riots and protests and looting, and it's just, it makes you wonder how a retailer can even get by, because it has to be psychologically just crippling to them. It's the absolute perfect, horrible storm. You have COVID, you have marches, then you have the looting, 3 definitely different hindrances to recovering for businesses that were struggling in the first place to get back on track. This unrest following the death of George Floyd is going to slow the recovery. And yet, somehow, since I've seen you, and all this has happened since I saw you last week, the markets haven't taken a rest. With the exception of today, and that's because we'll get to this in a little bit, the NASDAQ hit a new lifetime high. Not a recovery high, a new lifetime high yesterday. And so it's understandable that the market would reach that point and back off to see if it's a test of resistance. We'll get to that in a little bit. But these violent protests, I don't understand them myself. I understand that people are angry, but what I'm seeing is footage of minority small business owners running out into the street, just screaming at the protesters saying, "You're tearing up my business. I've worked my whole life. I'm on your side. I believe that this Floyd killing was horrible, but you're destroying my business." How can we either heal as Americans, and certainly how can we recover financially, if we're looting and destroying small businesses who might not even have sufficient insurance to replace what they've lost, or may not have the cash flow to sustain themselves while they're waiting for the insurance payments to come in? This concerns me in so many ways. As I said, on this program, I have to stick to the financial side. Here's another thing, and it's inevitable that this is going to be assessed probably from some of you as a political commentary, but why in the world, if I'm a business owner in North Carolina and I'm supplying the napkins or the folding chairs or the tables or anything for this huge Republican National Convention, and the governor says, "No, you can't come meet here. We're not going to guarantee that," and Trump, like it or not, pulls the convention out of North Carolina, I guess the governor just didn't think it was going to happen. I don't know what Roy Cooper was thinking about, but I know there are a lot of small businesses that have said, "We barely got through COVID. We barely are getting through the riots and the looting. And now when we have a chance to get a big hit of income, now we've lost that." My heart goes out to these people. It really does. And as a portfolio manager, I have to assess all of this and figure out, okay, how is this turning tide of sentiment in America? And certainly this is a red-blue issue, folks. It is a red-blue issue. How is this going to affect our investments? Because I can't let myself get emotionally involved in this when I'm making portfolio decisions for you guys. So I'm going to take a breather just a second here, check the comments, and I want you to think about this and give me a little feedback, please. Let's just dialogue here a little bit. Will you be attending any outdoor events this summer? And just type in the box here. I'd like to just hear everybody else see. When I say outdoor events, I don't mean a barbecue with the guy next door. I mean either an outdoor street festival, like for instance, Glen Ellen has this jazz festival here. We're 30 miles west of Chicago. And we do this every year. I think they've done it every year for over 20 years, and they're not going to do it this year. But there's some states like Georgia, like Texas, Tennessee, where they're going to have these outdoor festivals. Probably not Lollapalooza with 390,000 people in downtown Chicago, but okay, Altus, Charles, I see yes, you would go to an outdoor event. Anybody else? Let's get some sentiment here, guys. Tell me what you would do. Anybody? Or if you want, comment on an indoor. Is it any different? So I just mentioned outdoor events. Yes, I'd be okay with it. Ice, is that you'd be okay with outdoor or indoor? So would you go to Lollapalooza, Ice? I'd love to attend an outdoor event, says Tom. Just suspicious of what would still be open. Well, we don't know. Altus, yes, in Florida. Okay, good. Fran, I will attend one outdoor event 4th of July in North Dakota. Good for North Dakota. That's great. Good to see you, Fran. Indoor, no, says Thomas. Rex, outdoor. So I'm seeing what I thought I was going to see. Thanks, guys, for doing this. Not Lala, but a smaller outdoor is okay. So if Tool or Yellow Card is out there, you'd go see them. Tommy, is that your yes for indoor or outdoor? Oh, Martha. Hello, Martha from Michigan. Be comfortable with both indoor and outdoor. Okay. Yeah, because, when it gets to be July in the South or even up here, you might be glad you have the air conditioning. Might be a fair trade-off between that and COVID. So, guys, thanks. That helps a lot. That tells me a lot. Very good. Appreciate that. All right. Part 2, U.S. economy. So there's a lot going on. Keep trying to bring in the good numbers. Over the last 12 years that I've been doing these speeches, I've talked a lot about GDP, and we're going to get more into that in just a little bit here. So these numbers you're seeing, I think, are eye-popping. We have had this enormous pandemic, which is the worst we've had in 100 years, followed with riots, looting, and civil unrest commensurate with those that are old enough, and I'm one of them, I see a few more people online that are too, to remember the 60s when Martin Luther King and Kennedy were killed in the same year. And yet the market, the NASDAQ is up year to date. It is positive on the year. And frankly, a 7% return for an entire year is not a bad return. Not a great return, but it's not a bad return. If you annualize that, we're like at 15%. After the NASDAQ was down 38%. Guys, I have to stop on this and just take that in. I understand that the S&P is down. The Dow is down, although they're both catching up. We've had a flip this last week where what we call value or the underpriced indices have been catching up. Russell's still lagging, but when I first started doing these, Russell was down 38% back in March. So you can't see the numbers on here, but don't worry about it. What I want to point out to you, I don't know if you can see my mouse, you probably can't, but look at the V, okay? The V is really, really important. This is a V-shaped recovery. And people wondered if we were going to have that, and we have, at least in the NASDAQ. It's just astounding. It really is to me. So where's the S&P in all this? Well, again, you can't see the numbers, but just look at that sort of looks like what I'll call a lazy V. So the S&P is lagging the NASDAQ, and that's because so much of the technology power is in the NASDAQ index. But the S&P is still above its 200-day moving average. It's still making a valiant effort to get back to old highs. And I'm encouraged by that. This is a new graph. I've never shown you this before, but this is what's called a temperature graph. So cool, light blue, is good. So if, again, you can't see all the numbers, but you see the colors, right? So the top is FANG. Now, those of you that have been with me know that I've talked about FANG: Facebook, Amazon, Apple, Netflix, Google. That's FANG. And if you just look at those stocks, they have been mostly blue, and they were the last to go into the downturn. Can you see that? They got dark after everybody else, and they got blue sooner than everybody else. It's real important visually. That's why I'm so glad we can do the slides now. As you can see that these big mega cap stocks are the ones that are really making this recovery work. And down here at the bottom where there's hardly any blue, that's the all world index. So the rest of the world is not having the recovery that we are having here in the U.S., which is why we stay predominantly invested in U.S. assets. Now, if you read the press, you're going to see these kinds of articles. The CBO, all right? This is in the U.S. It's the budget office, central budget office, says the economy could take 10 years to catch up. How will they know possibly if this is 10 years or 8.5 or 5.5? I'm looking at the market because the market bets rather than with its words, but with its money. Now, I'm not saying money is king of everything, but if somebody wants to give me a poll of a bunch of economists as far as who's going to win the presidential election, or if they'll show me 5 bookies who are taking bets, I'm going to go with the bookie every time. Not because I approve of what they do, but because when people have their money on the line, it generally means they should be. If they're not, they shouldn't be using it, but they're well informed. And I'd like to think that that's what we're all doing here. So I don't know that it's going to take 10 years. I really don't. I don't think so. We're seeing consumer sentiment. You know, this is Michigan consumer sentiment, one of the best harbingers. People say that psychologically this is even worse than the last recession. Well, I'm not seeing that. You guys see this red line here coming down to about 73? Look at where it was back in 2008, 2009. You see these two dips here? I don't see this down here. Now, could it continue down? I'll circle back here in July and August and we'll see if it does. I don't think so. I don't think so, folks. The data contradicts what many in the markets, many in the media are telling you, not the market. So it's fair if you were to say, look, the markets look great. I get that. But when does GDP, when does the gross domestic product catch up with the market? Well, GDP is a lagging indicator. The market is a leading indicator. Why is it so important to understand GDP. And although I've talked about this for 12 years, I've never really gone into the formula. And so I started doing this on my own, and then I realized there's probably a better way to show you guys this. And that's what we're going to do right now.
There's one big economic indicator that economists pay attention to when figuring out if the country is in a recession.
GDP, gross domestic product. It's our biggest measure, most important measure.
The current economic slowdown caused by the coronavirus crisis has many worried that the United States has entered into a recession. U.S. GDP shrank by a 4.8% annual rate in the first quarter of 2020. It's the largest contraction of GDP since the last recession and ends the longest economic expansion on record. Here's what GDP is and why it's a key measurement to determine whether the country is in a recession. This is the formula the government uses to calculate GDP. It tallies all the goods and services produced in the U.S., from the dinners we serve at restaurants to the cars we produce in factories and the flights we take from airports. According to the Commerce Department, the United States produced over $21 trillion worth of goods and services in 2019.
Because GDP is a measure of the entire economy and aims to capture almost everything that's happening in an economy, economists have chosen the broad definition of a recession as 2 consecutive quarters of negative growth.
To calculate GDP, economists first calculate consumer spending, or the day-to-day purchases that everyday Americans make. Consumer spending makes up about 68% of GDP.
And that share has got bigger over time as the US manufacturing industry has got smaller.
Consumer spending fell 7.5% in March, as businesses shut down and government stay-at-home orders came into effect.
Americans have continued to spend online, but what they've bought online and had delivered to their homes hasn't compensated for the loss of other activities since the pandemic started.
Another major component of GDP is business investment. This includes things like companies building factories or buying machinery.
That's important to the economy, not only because of the activity it produces, but also because business investment produces productivity gains. For instance, by making factories more efficient or enabling the energy industry to extract more oil and gas.
Business investment was on the decline before the outbreak and has continued since lockdowns began.
And there are really 2 main reasons for that. The first was the trade war between the US and China that created a lot of uncertainty for businesses and their investment plans. And the other were oil prices. Low oil prices were definitely a deterrent for US energy companies to invest in structures and new drills and new wells.
Government spending also contributes to GDP. The U.S. government spends money on everything from equipment for the military to government employee payrolls. And government spending has continued to rise through the first quarter of 2020.
And it's going to increase a lot more in the quarters ahead. And that's because of the multi-trillion-dollar stimulus packages that Congress has passed to help stimulate the economy out of its current downturn.
GDP also adds everything the U.S. exports and subtracts everything it imports to calculate net exports. The United States has been importing more than it's exported for several decades. In the first quarter of 2020, net exports rose, meaning there was a slight narrowing in the trade deficit.
Normally that would be a good thing because it means that the US is importing less. However, what we've been seeing is that actually both imports and exports have been falling. It's just that imports have been falling more than exports. This is not necessarily a good thing because it shows that demand is very weak.
Forecasters expect a much larger contraction of GDP in the second quarter, producing the 2 consecutive quarters of decline that define a recession.
Lots of economists are predicting declines of about 30% or more. That is a huge number. It is off the scale compared to what we've seen even in recent recessions. On the other hand, the hopeful scenario is that we see this big drop in the second quarter and then the economy might start to recover.
So as I've said in previous episodes, GDP is expected to make a significant turnaround, not this quarter. The numbers when we get to July and August and we look back on the second quarter are going to be terrible. But the market is forward looking. The market is looking at least 6, mostly 9 to 15 months ahead of time. And when the market's doing that, it's seeing that this was an aberration, this was an anomaly in the American landscape of successful commerce. So, as I've talked, and you saw in the video now, 3 components: consumer spending, business spending, government spending. But the most important is consumer spending. What do we have going for us? Remember that savings rate that I talked about earlier? I'm waiting to see how that is tapped into. And as far as consumer discretionary stocks, that's what I'm going to be following as I invest for you this autumn, when people see what I believe is going to be a more stable environment. So on the chart here, real GDP by sector. So we have consumer spending, business investment, housing, inventories. You probably want to check this if you do a rerun on the show. It's a little more than we can go into right now. But the biggest hit, as would be expected, was in consumer spending, because consumers got their checks from the government and did what with it? Well, you already know. They saved it. Okay, and in the short run, that's a good thing. Candidly, in the 30 plus years I've been doing this, it's my impression that people don't have a large enough emergency fund, and in some cases, this may be a blessing in disguise, giving them the opportunity to beef up that savings account so that they've got a bigger emergency fund. But then we certainly want them to spend it this autumn. Thank goodness it looks like this is not going to mess with Christmas too much, and that's a very big positive for sure. So, okay, so this is the way I end this section each time. The data is so small, and I'm sorry about that, guys, but basically we have earnings reports coming to an end. We've got 491 of the 500 S&P companies that have reported. 66% have beat expectations. You might think, well, that's not bad. Well, normally it's 73%, and this is the first quarter. When this data is going to get really interesting is in July and August, when it's looking back at the second quarter. Now, again, we could have some real surprises to the upside, because the market is not that often surprised to the downside, at least as far as earnings. And that's a complicated reason, but there is a reason for that. They were blindsided by COVID, and that's why the reaction was so volatile and so fierce. Okay, so it's a little tidbit for you. We're throwing around 2 trillion, 3 trillion, a trillion here, a trillion there. Sooner or later, it adds up to be real money, right? You probably heard that before. So look at the chart here. Dwight Eisenhower envisioned the National System of Defense. That's the interstate highway system that, since I was born in 1955, I've driven on my whole life. The cost of the original system was $114 billion. $521 billion in 2018. The whole 48,000 mile system across the country was built for less than $500 billion. Maybe they were spending money more prudently back then, but I find that particular datum pretty amazing. So we will have to address this enormous debt that the country has built up, but not in this episode, and probably not even this year. We'll get to that next year. So let me reach out to you guys again here. What do you think here? How do you feel about yours and America's future? We asked this last week. We got some good answers. We got some new people on tonight, and I just want to see, what do you think? Is the worst still to come, or is it looking like the bottom is in? Bottom is a good thing here, like the chart. It looks like maybe things have gotten to be as bad as they would be. While you're filling in these answers, I'll just tell you the low in the market was 2191 in the S&P 500 on March 23rd, which is exactly 1 month after the S&P started collapsing on February 23rd. So this whole bear market that lasted just a few weeks, depending on which of the indices, was even less than 2 weeks in the NASDAQ, and then now is back in a bull market. That the low is March 23rd. I don't think we're going to revisit that low from the stock market's point of view in our lifetimes. But the economy could bottom later in that and then recover. So that's what I'm looking for your input on this. So the bottom is in, says Martha. Tommy, I think we still have a ways to go, so the bottom is not in, okay? Bottom is in, says Alice. Anybody else? Would love to know your opinions. We're trying to make this interactive, improving, and you're hopeful. Thank you, Rex. That's good. Charles, best is yet to come. Very bullish. Yes, if we can get rid of those naked short sellers, right, Charles? Someday I'm going to cover option strategies in here when we get a little headroom, but I didn't have any headroom this week because of what's going on. So, All right, guys, thanks for your answers. I appreciate your optimism. Here is our new segment. All right, here we go. Bottom is in. Let me get Chris here. Still have some worry about pullback likely. Sure, but we're not taking out March 23rd, right? You and I agree on that. Bottom is in, says Tom in Lake Geneva. Yeah, when you live in Lake Geneva, and that beautiful lake, you just tend to be an optimist, and that's good, Tom. I'm with you on that. So, bull case, bear case. People want to know why I make the decisions that I make for your portfolio. Some of you guys on here are clients. Some of you are just interested in hearing me yak, and that's fine. We're glad to have both clients and non-clients on here. So here's how this works. Here's tonight's new segment. Bull case, bear case. Each week I'm going to look at both sides of the argument for owning a stock, and then I'll reveal whether I'm a buyer or a seller. Now here are the signals, okay? So when a market maker, this is at the New York Stock Exchange, wants to buy, now most everything's done on computers now, but back in the days when they made hand signals, he puts his hand toward himself and says, I want to buy, okay? So that's what a buy means. When he wants to sell, he pushes away, okay? So we're going to use these little signals here to designate that. And then, of course, there are times when you can't really make up your mind as a portfolio manager. I don't know where they got this Jasper on screen. Alice, where'd you get this guy? Anyway, I think you get the point. So let's see if we can have a little fun with this. A lot of what I'm talking about this week is technology-driven stocks because technology is driving the lion's share of change in America. And that technology then serves as a prism into the values that we have as humans. Now, I'm not making a value judgment that we should do that. I'm simply saying that that's what we do. People are a lot more interested in many ways, rather than going to get a physical checkup, they want to get the latest iPhone, okay? People are have a great appeal to technology. So let's see what we have here. So Slack. Slack is a productivity software that allows businesses to interconnect. We use it here at our company. And we have outside vendors all over the U.S., that we connect with, and it is really cool software. However, year to date blew out their first quarter earnings, upbeat guidance ahead of today's earnings, but the bear case is that their revenue continues to fall. So they've got pretty good margins, but their gross revenues have been falling simply because, like many technology products, you can use them for free and then upgrade to the paid version. We used them for free for quite some time, actually. So despite this recent sell-off, Slack dropped really hard today, down 19%. I almost had to change my answer on this. But then Amazon announced 45 minutes later that they're going to be partnering with Slack and using Slack inside of Amazon, and they rocketed the other way. This just happened this afternoon, folks. I mean, I can't make this stuff up. So who wants to vote? Bull or bear? Type it in the chat box here, and we'll see what you come up with. Bull or bear on Slack. Now, obviously, when I'm making decisions, I do a little bit more research than this, folks, but I'm just trying to give you a little bit of a glimpse into the mindset here. So, but I've got several stocks, so I got to move on here. If anybody's going to type, that's great. If not, I'm going to move forward. And Slack wins the bull case. Slack wins the bull case. Next is UAL, United Airlines. So actually the bull case, now I'm going to mention American Airlines here as part of the bull case, because it's increasing their domestic schedule due to improving demand. Now, we like seeing that improved demand. In fact, they're expanding their domestic flying schedule for the summer, and when the market saw that today, American Airlines surged 41%. Now, this is kind of a tricky answer. May 19th, UAL, and that's who we're talking about, not American, but UAL, reported that it expects scheduled capacity down 75 to 90% in May and June. American Airlines demand appears to be comparable to UAL. So why is the disconnect? That's something as an investor I got to look at real hard. Is this a bull case or a bear case? Who wins it? Anybody want to type in the box? I know this is a new segment, so you guys are all getting shy on me here. Anybody? All right. Here we go. United Airlines wins the bear case. Yes. Okay, ICE. Dog. Yes. We used to say dog with fleas or with ticks. All right, Bear. Very good, Fran. We're all on the same page. Oh, Alta, so you're a value investor, Charles. Okay. You know what? You let me know how that works out. Speculative buy with sell after the bounce. Okay, well, Chris's description is called what's a value trader flip, where you buy a dip, you let it ride up to where it would normally be resistance, and then you'd sell it. So that's a cool idea too, Chris. As longer-term investors, we generally don't do that. What about Adobe? So revenue growth has been slowing down, but are they going to bounce back in the later part of 2020? I'm already seeing that. We're a user of Adobe too, so I try to use as much as I can of the stocks that we own because I get a pulse on what they're doing. I think the media has, an overarching impact. So their digital media, which is their recurring subscription process, I pay $140 a month for all the different subscriptions we have, but it's a lot of software for that. It's a really good value. But the bear case for them is that, the market, the guys that are doing the analysis on Adobe that are bearish are seeing that this revenue is going to slow down. And even though they're well positioned, the stock is priced for perfection. You may have heard that phrase, but it's a phrase we use in the industry all the time. Price for perfection. Does not offer a compelling risk reward. That's what that guy says. Or two or three of them. Adobe, strong buy. Okay, that's good. Thank you, Charles. Anybody else on Adobe? Adobe. Gone once. Gone twice. I agree with Charles. It is a strong buy and remains in our CG and SG portfolio. Thank you, Tom. Yeah, you're a bull as well. Okay. GM. All right. We're going to talk about two different automakers here. Buy. Their formats fit well with the teleconference. Yep. Yeah, they do. Adobe's good. So GM. So the suppliers that are familiar with GM and Ford know that they need trucks and commercial vehicles to sustain their business, and their suppliers who are dependent again on GM and Ford selling their product said, don't leave the door open on Tesla to make trucks. You did that on passenger cars. In other words, hey, we're your suppliers. You guys got arrogant and thought, nah, Tesla's never going to do that. And they did. Now, if you think that about trucks, you can be wrong twice. Okay? So that's a concern. The bear case, the bull case should be that GM will go, oh, okay, we're definitely not going to let that happen. We're going to be real serious about this. In fact, they've got a new electric van that's supposedly aimed at business users, and it's going to start production late next year. Well, okay, you're already a year and a half behind, but the bear case is just on market cap alone, Tesla is by far the most valuable car company in America. And how they got there is an incredible story. They have a very strange CEO who is a spacehead as well as other things too. Sell, run, hide, pretend you don't know them. Okay, here's the answer. You probably figured it out. General Motors wins the bear case. Sell that thing. Sell it. Not holding it in our portfolios. We do, full disclosure, own Tesla in CG and SG, and you get to hold. Okay, Charles, you must hold it then. You must have it, so you're holding it. Okay, we'll see how that plays out. One more, guys, and then we'll be done here. So this is Macy's. Macy's, okay? We're wondering if you think they're going to have that parade in New York? I don't know. We'll see. First time they would not have had the parade in, decades, right? So the bull case is whether Mr. Market is aware of it or not. Macy's is the 10th largest e-commerce company in America. 10th largest, which is, sizable. Despite COVID, Macy's cash burn wasn't much higher than normal. I don't know if I liked how that said. The cash burn is not much higher than normal. Mainly because the company extended payment terms with suppliers. All that's doing is I'm kind of giving this away here. But that's bullish because their cash flow has not been hurt. Frankly, I think they're just kicking the can down the road. The bear case is pretty much said in one chart. I didn't write a lot on this. This is a chart since 2008 of e-commerce versus brick and mortar. Which color do you think is which? Macy's is a sell. Yep, you suppose? Sell. Anybody else? Gotten a value player out here? Where's Chris? Mr. Value Player. All right, here's my opinion of Macy's. Are you kidding me? Macy's wins the bear case. Now, that doesn't mean we've owned Macy's before. And being the 10th largest e-commerce supplier, merchant in America is a good thing. But after 1, 2, and 3, and 4, you know what? 10th is like almost negligible. Nobody remembers who won. If you remember who won the Daytona 500, nobody remembers who came in 10th. So can they come back? I hope so. I'd like to see some brick and mortars, with their blend of e-commerce and brick and mortar succeed. But right now they're not. So we're wrapping up, guys. I was trying to get this to 45 minutes. I kind of got carried away in this section, but it's the first time. Some people have said, is Alice still with you since you're putting in 80-hour weeks to do these shows? And the answer is yes. My lovely, wonderful bride is with me. We are thriving, bringing you these videos, and I am so blessed with her support. There we are. So, guys, thank you for watching. We really appreciate that. Here's the thing. I just want to ask for some help here. We're trying to get to 1,000 subscribers by New Year's Eve, okay? And it would really help me if you guys could pass this on to other people. We think we've got a pretty good program. We get the feedback from you that we are. Send this link to other people that you know, friends, family, even people that may not be friends, but send them the link. And it would really help us a lot as we try to get some momentum and get to 1,000 subscribers. If you want tonight's slides, make sure you're on our mailing list. Send me an email, cb3@cb3.com. If you're listening here for the first time and you're wondering, well, what are they going to try to sell me? I don't sell anything. I'm an economist. I do manage money for people, but I don't send out emails looking for business, okay? So thank you, Tommy. Good for us hanging in there with this crazy guy. Yeah, okay. I appreciate that. Please share all of this to Instagram, Twitter, and Facebook. Yes, please do. We have pages for that, and we're going to be rolling out some new website, social media stuff we'll tell you guys about, okay? But please do invite people, okay? It would mean a lot to me if you did that. I never take for granted that you guys are here on your Thursday nights, and now I know as the weather gets nice and, candidly, you may not be locked inside, but you're on here and watching this, and I really appreciate it. I don't ever take it for granted. Thank you, Tom, for saying that. As Ed Sullivan would say, a really good shoe. Well, I appreciate that. Tell all your friends. We appreciate it. Thank you, Charles. Appreciate that. Guys, stay safe out there. COVID is still with us. I hope we're not going to have a second relapse. That happened, obviously, in 1918. I think the government's going to do everything they can to keep that from happening. Obviously, there are huge financial and political reasons for that not to happen. And I think we're going to see this developing over the course of the summer and autumn. It's a fascinating time to be alive. May God bless each one of you. Again, Alice and I so appreciate you being here on Thursday nights. Please send us an email if you got any questions, if you want more follow-up. And we'd be happy to talk to you one-on-one if you've got a question you didn't want to put here in the chat box. But we'll be back next Thursday night, God willing, and may He bless you until then.